Hello and welcome to this December edition of Amundi's Market Review. November has been an extraordinary month. Equity markets are showing double-digit gains, credit spreads tightened, as perceived risk of defaults diminished and implied volatility halved. Before entering into market performance in more detail, let us look at the three major events moving the markets. We have Joe Biden as the next US president. For the US election cycle to be over, we will have to wait until January the 5th, when the result of Georgia's runoff will define the final outcome of the Senate. President Biden nominated his cabinet, and this announcement has been very important for investors. Janet Yellen's appointment is good news for markets with their pro-growth, credible, bipartisan approach. The US Treasury and the Fed will be close and work together on the economic recovery and fight against inequality. Kerry's pro-climate policy and Blinken's pro-Europe and multilateralist stance are also good news for the market and ESG investments. Groundbreaking progress has been made in the development of effective COVID-19 vaccines. These developments could put the health systems in position to control the virus by the middle of next year. Markets reacted, perceiving the glass as half full, therefore ignoring the several steps still needed to confirm expectations. Trials still have to be completed, governmental authorities will have to review the full process, and logistics for mass distribution and inoculation will have to be engineered. However, we do now have a light at the end of this tunnel. On 15th November, following many years of negotiations, the 10 Southeast Asian economies, members of the ASEAN and their trading partners, China, South Korea, Japan, Australia and New Zealand, signed the Regional Comprehensive Economic Partnership, or RCEP. This agreement will complement existing free trade agreements and further streamline standards, such as rules of origin. In a challenging context for global trade, this agreement highlights the benefits of multilateralism and is very welcome news on the geopolitical side. So, how have markets behaved over the month? In November, equity markets took off. European indexes were to the top performer, the Bloomberg European 500 plus 15%, EU value plus 21%, and Hang plus 11%, topics more than 12%. Finally, but crucially, the S&P 500 climbed 11%, turning back to green its year-to-date performance at 10%. On the rates front, the 10-year Treasury in nominal terms registered quite ample movements over the month, but closed almost flat relative to the start. Vice versa, the US 10-year real rate re-rated 20 basis points higher on the positive vaccine news. Moving to Europe, the Bund lifted 4 basis points, both in nominal and real terms. Interest rate spreads on peripheral countries such as Greece or Poland tightened remarkably. In currencies, the US dollar weakened versus the euro almost 2.5% and lost ground against similar-sized emerging market currencies. Commodities showed large movements, with oil moving to $45 per barrel on the West Texas Index. And as a reaction to all this renewed market optimism, gold retraced lower towards 1800. In November, investors broadly repositioned on risk assets, with equities and commodities taking the lead. However, overall risk asset positions remain below pre-pandemic levels and suggest the rotation has further room to continue. In conclusion, markets are likely to look ahead to the logistic of next month and want to go higher. The economic backdrop remains supportive for risk assets, although soft data could stop drifting higher due to the second wave. With a cyclical view entering 2021, we see the recovery phase approaching, though still within a regime of low rates and abundant liquidity. This, in our view, will support risk assets and equities in particular, with a rotation of themes looking for cyclical opportunities and a recovery in the unloved value sectors. Thank you for listening. Please keep safe and see you next month for another market review.